To me, ChatGPT-4o is a tool, and it's not a standalone tool. It's always like a closed system of if you want, cyber-biological system of human-computer interaction. So, and the goal of using this tool is to amplify human intelligence. And otherwise, it wouldn't be a chat interface, right? And yeah, in today's video, I want to perform another valuation. So yesterday we used ChatGPT-4o to value Nvidia stocks, and in yesterday's video I basically put myself back. So I tried to, like, I just more or less asked ChatGPT-4o on its opinion about Nvidia, and I didn't put too much of my own biases into it. But I think this is not the best way of using it, because yet as long as we haven't reached AGI or so. So you can check out yesterday's video, and by the way, subscribe to the channel if you like this kind of content anyway. In today's video, I want to instead analyze Tesla, the company, TSLR stock. And basically, I want to determine a fair value market cap based on several business segments. And in this video, I will inject my own biases a bit more, but I will still like use a beginner's mindset. So I have studied Tesla a lot, but I will just like assume I don't have any numbers and so on. So maybe you can follow along how I do my analysis. As a reference point, I have had more than 40% compound annual growth rate during the last 10 years using like investments such as tech investments and among other things to accelerate my wealth creation. Okay, so just as a reference point. Okay, so Tesla has several segments. The first segment we will look at is the car segment. And they have the Model S, Model 3, Model X, so Model Y. So this is like the sexy Model Y line, right? S, E, 3, E, X, and Y, sexy model line. And then we have the Cybertruck, and these are the vehicles. We will see a couple of more vehicles, and we will do some like very basic napkin math on the vehicle segment. But I think Tesla is much more than I know Tesla is much more than a car company, but it's still one of the growing segments, so we will still value it. And today Tesla is mainly valued as a car company. Then we have the energy segment. They sell not only solar panels, solar roofs, which is kind of not very relevant for the valuation, so we'll basically skip this. Also, power walls is not a big Tesla segment, but Megapack is. Megapack is a huge segment, and we have seen significant growth rates in recent quarters. Finally, we look at the Optimus segment. This segment is currently not contributing any revenue, but it already shows very, very promising developments in recent months, and we will soon see a massive scale up of humanoid production. They have already produced humanoids. Some of them are already working in the factory at Tesla, and yeah, soon we will see this kind of. It's like the humanoid robot is the inverse idea of the metaverse, if you want it. So you have the metaverse where humans actually enter the digital sphere, the digital environment, and do stuff in the digital sphere that they could not do in like externally. I believe the metaverse is a very valid concept, despite its recent kind of challenges, and everybody hates the metaverse, but it will come back very, very hard in my opinion. But anyways, the humanoid robot is kind of the inverse idea of this. So we have now the digital space, the cyberspace, actually finding embodiment in the real world and coming into our worlds, into the physical space, the space of atoms, not bits. So we are not entering the space of bits. We are the humanoids or the robots or the AI enters the space of atoms or the environment of atoms. And the humanoid form factor is important. I mean, it doesn't really matter how the legs, for instance, look like. So, but it matters that they have legs, so they can enter. Actually, it's the perfect API for the human space, so we can easily integrate them into any factory, into any home, into any street. So everywhere where there are humans, there will be humanoid bots. And yeah, so here comes my bias. If you would ask ChatGPT, they would probably have very conservative numbers. I believe the humanoid robot segment will be as successful or more as the smartphone market. And the smartphone market, like over two decades or so, has gone from 0 to billions of units. So billions of people have a smartphone today. And we will see the same, right? So we will see billions of humanoid units walking on the planet. Everybody will have one. So probably we will see tens of billions of humanoids, and it will just scale labor infinitely. But this, of course, will not happen overnight. This will happen over many years, and probably after 10 years, we will still not see billions of humanoids. We will still be in the scaling up production phase. But the companies that are proven to be leaders in this space will already be highly valued, because in 10 years, as we scale up the production of humanoid bots, it will be obvious for everybody. Like Google is obvious today, or Amazon was obvious 4 years from 4 years ago. So these are the different segments. So once again, we have the car segment, we have the energy segment. Here I did some initial prompting. We have the car segment, we have the energy segment, we have the Robotaxi segment, and we have the humanoid robots segment. Okay. So I want to value Tesla using a sum of the parts analysis. And the first part is the car business. The second part is the energy segment. The third part is the Robotaxi segment. And the fourth part is the humanoid robot segment. Okay. Let's start with the car business. Okay, the first, for each segment, and this is the main idea of the video, for each segment we want to perform a DCF analysis using 10 years of projections and a custom discount rate. So we will talk about this in a minute. Okay, so this is how I would approach valuing the Tesla business, because like it's a sum of a part, right? It could be also four separate businesses, each generating their own revenue. Let's start with the car business. So first it says, okay, we need to project revenues and expenses. Then we estimate the annual revenue growth rate, forecast the revenues for each of the next 10 years. We estimate operating expense, cost of goods sold, forecast expense for each of the next 10 years, calculate EBIT, and so on. Okay, initial revenue, assume Tesla's car business revenue is 50 billion in the current year. So let's confirm this. Tesla revenue car business. So basically, I think the numbers might not be the most recent numbers, right? So let's once again Tesla revenue cars should be like automotive sale accounting for over 78 billion US dollars already in 2023. So this one is basically not it's a wrong assumption. Okay, so let's break this. Let's stop this, and we need to basically give more information here. Okay, let's start with the car business. For each segment, we want to perform a simple DCA analysis. I think it did too much complicated stuff here, and the complicated stuff we don't want. So for my own analysis, I always hate complexity. I try to reduce complexity wherever possible. So for each segment, we want to perform a simple DCF analysis using 10 years of projection of revenue projections, and a custom a profit margin and a custom discount rate. Okay, let's start with the car business. First, figure out the most recent revenue from car sales and the net margin to get the net income. We will use net income as a proxy for free cash flow. This can be done. It's not too accurate, but it gives us like it gives us a good rough estimate, right? As a proxy for free cash flow from car sales. So let's try again. And this will take a while, but I think we will get a good estimation of the Tesla stock price as a result. So stay with me. Okay, for the car business segment of Tesla, we can use the most recent data to establish a base for DCF analysis. In 2023, which is last year's, Tesla's automotive segment generated revenue of 82 billion. And for simplicity, we'll use this as a starting point for the revenue projection. So 82 billion seems reasonable to me, right, as a starting point. To derive net income, we need to consider the margin. Tesla's operating margin was 8.2%, and so it could be around 5 to 7% given Tesla's growth and efficiency. Let's assume a net margin of 6%. This is not too bullish. I actually think Tesla net margin could be even higher. So I always like Tesla net margin cars. Net profit margin could be like as high as 14%. It has been it has been fluctuating, right? They will make more money from full self-driving than they will make from car sales, obviously, but here net margin we have like 10 to 15%. This is like from raw car sales, and here we see initially we have had a minus 2% or so, and minus 3% in 2019. So in recent years we have been growing the net margin as we have produced more units. So basically I want the net margin to be higher. In my opinion, net margin should be around 15%, especially as they grow production. Future growth should be around 50%. No. Let's keep it maybe a bit more conservative. 40% for the next 10 years, and I will confirm this in a minute. It didn't say anything about the growth rate, right? So maybe future growth estimate from past growth. Would you say growth rates go down or up from here on? I have my own opinion, but I will first want to ask ChatGPT before I induce my own biases into it. And as I said, this is like a tool, right? It's a tool to amplify my own limited intelligence, and that's how I use it. And of course, this will have my biases. So before you comment that these are biased estimations, definitely they are. They always are. For all valuations, you have a human bias. Okay, so we have revenue 82 billion, net margin 15%. Tesla's revenue growth in the past has been impressive, often exceeding 50% year over year. Past growth rate was approximately 50%. Future growth rate projections starting at 30% in the near term, gradually declining to 10% by year 10. I think this is way too bearish. I think we will see far higher growth rate, and it starts at 30. So if anything, I would start at 50 and then gradually declining to 10% if they want at year 10. But I would say even like it could maybe maintain a 30-35% growth rate just for unit sales in the car business. Why is that? Because we are moving from a world where all cars are combustion engine cars to all cars are electric cars. So we need to go from, say, a 10% or so electrified fleet in the world to 100% or 95% electrified fleet. So there will be significantly growth, and it will look like an S curve. And S curve, and why is that? Because electric vehicles reduce in cost with each cumulative doubling of production. This is Wright's law, and it's at play for companies such as Tesla, where they are mostly based on production efficiency, learning effects, and so on. The more units they produce, the cheaper the batteries. For instance, batteries are one of the most expensive items to build a car. The higher the learning effects, the higher the automation degree, because if they produce more units, they can optimize factories better, and the cheaper the cost per unit. Also, the higher the net margin usually, but then there's competition, of course, which means that the cost basically come down, and it is just too convincing to buy an electric vehicle. It is cheaper. There's less maintenance overhead and all the different advantages. I drive an electric car myself, and let me tell you, everybody will drive an electric car, especially as autonomous vehicles are coming, because if you want an autonomous vehicle, you need to have an electric car. There's no possibility that we will see autonomous vehicles on cars that are not electric. Just look at all Robotaxi networks; they all use electric cars. Okay, so I will adjust these numbers. Past growth rate approximately 50% per year. I think, and then future growth rate 30% declining to 10%, and also the net margin they keep constant at 15%. I think the net margin would even, let's keep it constant because of competition. So let's give it that. Okay, now we know what it thinks about the. I don't want to clutter it up, right? That's why I changed this one here. Future growth rate, net margin should be around 15%. Staying constant for 10 years. Revenue growth rate should be around let's make it 35% per year. So I sandbag this a bit. I actually think it's higher, but let's make it a bit smaller so we are not too bullish on the companies. Okay, so revenue growth should be around 30% per year for the next 10 years. This also maybe accounts, maybe they could even grow the unit sales by 50% or so, but then selling each unit for cheaper. So actually we will sell more units, and it will become more attractive for the consumer to buy those cars. Okay, and discount rate should be 10%. So 10% is kind of my go-to discount rate. It's a bit higher than S&P 500, accounting maybe for the slightly higher risk. What did they use? Yeah, they also used like 10%. It could be. You could argue, okay, discount rate should be more like 5%, but then we want to buy with a margin of safety. This is actually what Warren Buffett does. But use 5%. Why? Because 5% is like roughly treasury bills. So of course Warren Buffett doesn't use an explicit discount rate, but he has said once in a shareholder meeting that he's kind of doing a discounted cash flow analysis in his head for each company. This is how he sees companies. Companies are worth all cash flows from here to Judgment Day or so, discounted back to the present. And then when asked what is the discount rate, he said, okay, maybe it should be something like really the cost of capital, so like 4%, 5% or so, what you would pay for what you would get from a safe investment. And then you want to reduce the risk, basically. You want to buy at a certain margin of safety. So if your valuation gives you a value of X, you should buy the company at a value of X divided by 2 or so, right? By 50% of X. So this is kind of Warren Buffett approach. But I think Warren Buffett also didn't, maybe it's not a be all end all. He also didn't invest in high growth businesses. And for high growth businesses, I think we should definitely use a higher discount rate to account for the higher risk. And just cutting it by half doesn't matter too much, because if the growth rate is off by only a couple of percentages, half is not enough of a margin of safety, right? It could be 10 times of that or so, right? If you just are off 10 times or 1/10 of the number you get, if the discount rate is just off by a couple of percentages. So this is kind of it can be done by simple companies such as Coca-Cola that have a not too insane growth, but like for high growth investments, I think we should use maybe a higher discount rate of 10% for safety. Okay, even I sometimes use 15% or so, because I know like my own cost of capital are actually higher. I could invest, like historically I have invested at higher rates of return, at like not at 10%, but significantly higher, as I said in the beginning of this video. So sometimes I even use a higher discount rate to adjust to that. But okay, let's go with 10%. The higher the rate, obviously the smaller the numbers will be, because future cash flows are not as valuable if you have a high discount rate. Okay, given the assumptions, net margin 15%, revenue growth rate 35% per year for the next 10 years, discount rate 10%, and this is only the car business. Now it gives me the revenue in the year 0, which is 80 billion or so, and we have this 35% growth rate. And then they calculate the present value of the net income, and by adjusting with the discount rate given, and they sum over all the present values for 10 years. So here they do the exercise. You can see here the net income goes from 111 billion it's not even true, right? This number is not true. I don't revenue. No, they calculated this one, like the growth, the revenue numbers after year 1. This is basically the revenue number, and then they calculated the net income from this number. Okay, obviously we know that probably they won't reach this kind of net income in the next year, but probably they will reach a higher net income in 5 years or so, but we average this out. The cash flow from the first year is not too relevant for the overall valuation of the company. So even if we are off in this year or in this year, it doesn't matter too much. It's more important that we are right roughly right in 10 years or so. Let's calculate the present value for each of the net income. So here we have the net incomes going from 16 billion to 248 billion. And if they reach 248 billion, they should be valued more. So after the 7 years here with the 100 billion net income, they should be valued at least as much as Apple today, which would be very interesting investment already, just based on this, right? Because Apple today already makes 100 billion in income, but it's not growing too much. Whereas this company here, Tesla, is still significantly growing their car sales. So we have a present value of, if we sum over all of those, of 436 billion US dollar for the car segment, using a 10% discounted cash flow. Okay, but I think they did not do they did not add the terminal value, right? So that's why I say it's like an amplifying of human intelligence, because now we need to catch these kind of errors, otherwise the model would be wrong. What about the so, or did it include the So what about the terminal value? It knows what I mean, right? The terminal value of the discount. So after 10 years, we still have cash flows, and these cash flows are also important. And they use net income as proxy for free cash flow now, using the perpetual growth rate of say 3% and our discount rate of 10%. They now have the terminal value of this huge number, and now they need to get the discount this number back to the present. So we add 1,401.4 trillion to the valuation of the car business itself to obtain the 1.8 trillion billion dollar car business. So this means if Tesla can grow their revenues by 35% each year for 10 years, and they can obtain a 15% net margin, then you would be happy with a 10% cost of capital, then you could pay 1.8 trillion for the whole company. And if you look at Tesla market cap today, it's not even 1 trillion. It's like 777 billion. Okay, so it's 0.7 trillion. So basically this already means that if you buy this story, you could buy Tesla just based on the car business. And this is not financial advice. This is just here the outcome of this analysis. Okay, so the conversation is helpful so far. Let's continue with the next segment. Okay, let's move on to energy. Keep it simple. First, find the most recent number for energy in 2023. Revenue. So I want to talk about revenue. Second, find the most recent growth rates, July 2024, of the energy segment. Third, determine the net income of energy in July 2024. Fourth, suggest a 10-year future growth rate based on your own opinion. Okay, first, before it gives me like the whole DCF for the energy business, I first want to see its numbers and maybe iterate on its numbers. Okay, so the recent revenue it generated in 2023, it generated 6 billion from energy. The recent growth rates have been shown an increase of around 40% year-over-year increase, and net income was like was 15%, around 15%. It's similar to the automotive segment. I think it's good. Maybe the revenue could be a bit higher. And ChatGPT, he or she suggested a 10-year compound annual growth rate of 25%. And I think again it will be higher. I think might be like 50% or so because of the huge demand for AI and like energy and battery technology. It will just explode. There are so many. Like the total addressable market is even higher than cars, which says something. Like the car market is huge in terms of revenue. It's not huge in terms of profit, but it's huge in terms of revenue. But energy is even higher. So Tesla has significant contributions. The mega packs are like every school could have a mega pack, and it would be profitable for them to do so. And as we scale up solar energy, we will scale up. We will scale up battery technology significantly. I'm not as confident on the energy segment though, because it's just packed batteries, right? It's not. I don't see the huge mode of Tesla. I mean, I see the mode in terms of like battery technology, but I think the mode in terms of car production is much more significant, right? Because they have self-driving cars and stuff. They have AI in their car. Tesla, the brand for cars, is much stronger. So Tesla Energy is a great business segment. It could be huge. I'm not as confident as I am about the car, personally, about the car segment. And I don't know as much about it, to be frank. So I will maybe use a more conservative numbers. Okay, let's perform a DCF using 25% CAGR for 10 years. Use 15% net margin. Both could be higher, both probably will be higher, but I'll go for those numbers. and use what else? Discount rate. I'm not as confident, right? So I will slightly increase my discount rate here. Use 12% discount rate. So the revenue, they start with 6 billion. And now let's confirm this first. Tesla revenue energy 2023. Yeah, 6 billion, okay. They recently had very bullish revenue growth rates. I think they were significant. Tesla revenue energy 2024 growth. Okay, so they have had a 140% year-over-year jump in terms of gross profit, but only a 7% year-over-year increase in revenue. Okay, so I think it's like the numbers could be far more bullish if you have a higher net income level, but then the revenue growth rate is also bumpy. So I think these numbers are fine for now. If you don't know too much, you maybe should skip it and just use it as a margin of safety, but we will just still include it. Okay, revenue. They use this number here. So they start with 6 billion. They multiply with a 25% growth rate every single year for 10 years. After that, we have so we obtain the net income numbers here. Now here in this column, we have the net income numbers. They should be roughly 15%, which is true. Then we discount the revenue numbers to the present. So for instance, the cash flow of 8 billion here in year 10 will be worth only 2 billion after 10 years. And then we have the terminal value of the terminal cash flow of 95 billion. So after 10 years, we could sell the energy business for 95 billion, which would be worth 30 billion today, using a slightly higher 12% discount rate. So the total value of the energy segment is 48 billion. And again, the Tesla market cap is 777 billion. So this would be only a 5% impact or so on the, a bit more, maybe 6% or so on the current business. And but this is like currently you could pay 48 billion for the energy business, and you would get a 12% annual growth of your investment. If this would turn out to be true. And if you would pay less, you would have a margin of safety for if the numbers don't turn out to be true. Of course, the numbers could also be higher, and you need to adjust. Like if you invest into something, you always invest into a probability distribution in a way, right? It could be like there's also a 10% probability or so that this will go completely berserk, right? So we have 100% growth rate every single year for 10 years or so. And in this case, this would be much more valuable than the Tesla car business. So you also buy this option, it's kind of like a call option into the future. And if you would do like a total thorough analysis, you could sum over the weighted probabilities, the weighted outcomes. So you would assign a probability to each scenario, and then get a free cash flow or so, a valuation, perform a free cash flow valuation for this scenario, and you would get a net present value for your market cap, and you would multiply it with the probability and so on, yeah. And then sum over all probability weighted market caps, and you would get a fair value for this. And because there is a long tail, so maybe there's a 30% probability or so that the energy business is zero, but then there's also 30% probability that the energy business is worth trillions, and there maybe it's a 1% probability that it's worth 10 trillion or so, right? I mean, so I don't know, like just saying like random numbers, throwing in some random numbers. So the 1% probability of a 10 trillion is still worth 100 billion, right? Because 1% of trillion is 100 billion. And then you need to sum over the other scenarios as well. So it could be, it's a right-tailed distribution where you could have significant contributions from the low probability but high outcome scenarios. Okay, but we use this simple number, 48 billion, for the energy segment. Okay, let's go to the Robotaxi network scenario. Currently, we don't have any revenue. Let's assume we have 1 million Robotaxis in. So we already have a couple of millions of cars deployed. So it's just a matter of remotely activating the. Maybe we should not start with 1 million. I think it's not conservative. So we already have how many Tesla cars we have on the road. It's like 4 million or so, right? I did this analysis a couple of weeks ago. So let's say if you have 4 million or so, and the FSD update really works, then from those 4 million we could have like 10% or so Robotaxis. But you know what? We will just go we will do the more conservative one. I think let's do the conservative one. Let's go to the Robotaxi network scenario. Use the revenue growth rates from the car analysis, because this gives us to estimate the units sold in each year. Because if you have the revenue, right, we can divide by, say, an average sales price or so. That would be reasonable, and we can estimate the units sold in each year. Then use these numbers to estimate the number of cars on the road by assuming each car has a lifetime of 10 years. So we have a churn rate of 10%. Churn rate of 10% of cars on the road. Okay, and then we have the number of cars on the road in each year. With this variable, the numbers of cars on the road in each year. You can estimate the revenue and net income. Okay, so this is a very conservative way of doing it, right? Revenue is FSD take rate times the cost of times the net margin. Revenue FSD take rate will go up from 10% in 2023 to 80% in 2024. So this is now my own biases, my own assumptions. Why 80%? It will be probably even higher. Not in 2024, in 2033, so 10 years later. And then I will use 90%. Why is that? So the revenue, we value the Robotaxi network differently than others. We don't estimate the number of miles driven or so. We just assume you buy the car and now the car is yours, it's your asset. And this is a more conservative way, because in reality, Tesla will also make a certain portion for each mile driven, right? They will have the Robotaxi network app and so on, right? But another way to monetize the Robotaxi network would be just to sell the FSD subscription. And as a car owner, I could then buy the car, I could add the FSD subscription, and now the car could make me money, could operate as a Robotaxi. And if I pay less for the FSD subscription than I make for the FSD subscription and the car maybe, then I make from the Robotaxi revenue, then it would be a profitable thing for me to do. So Tesla could also, instead of taking a share for each mile driven, they could also just increase the cost of the FSD and kind of pull the economics out of the Robotaxi network this way. And I think it's a more conservative way to look at it, and it's a simpler way as well. And I always like more like simpler ways. It is not inferior in terms of, it's just another business model, right? Because the FSD, if the Robotaxi could make, say, 200k a year on a crazy number like this, I don't think so, but if one Robotaxi could earn 200k in revenue, then the cost for FSD could be 100k per year or so, right? And this would be then similar to using a 50% like platform fee for the Robotaxi network for the app. Like Uber takes a platform fee, and Uber probably takes like a 15 or 20% platform fee. I don't even know, but they don't use like a 50% platform fee in my knowledge. But yeah, so that's why I just want to defend this way of thinking about the Robotaxi network. Using FSD is not an inferior way. It's like the same. It's the same, and we don't know the business model, but it's a way to extract cash basically from the Robotaxi network, and one way or the other, the economics need to be right for the Robotaxi owner. So if we don't charge for platform fee, we need to charge a higher FSD, but we cannot charge too high of an FSD, otherwise the owner wouldn't make any profit and they wouldn't purchase FSD in the first place or join the Robotaxi network in the first place. Okay, so FSD take rate will go up from 10% in 2023 to 90%. And in order for it to go up to 90%, we need to make the economics very, very convincing. So every car owner would basically buy FSD even though it seems expensive. And they would do so if they would make a lot of money out of it with a very low risk and overhead. And in order to do this, we assume the cost of FSD going up from, say, 1,200 a year in 2023 to 12,000 a year in 2033, which would be a steal if you could really make 100k or even 50k or 60k in revenue, right? So most people would just do it and then maybe sell their Robotaxis to a fleet owner also if they want, or rent it to a fleet owner. But you would still use a full self-driving update. You would still use this. And then use increase your net margin from FSD, starting with 30% in 2023. Probably the number is already higher. Ending with 70% in 2033, because in this year it's mostly a software business with software net margins. So let's see how it goes. Probably we will need some iterations here because it's pretty complex. Okay, using the car revenue growth rate of 35% per year for the next 10 years, we estimate the number of cars sold each year, assuming the number of units sold in 2023 is proportional to revenue in 23. So units sold is 1.8 million in 2023. They start with that. And then we get the yearly projections for units sold, going to like 36 million units sold. This is not in year 2030, but in year 2033. And in year 2030, we will have maybe 10 million units sold. And I think we will be right on track. I think Elon even said at some time that they target 20 million in 2030, if I'm not mistaken. So 10 million would be still conservative regarding this target. So cars on the road, we simply sum over all units sold in a given year and multiply it with the churn rate. I think it makes sense. And FSD take rate increases linearly from 10% to 90%. Annual FSD cost increased linearly from $1,200 to $12,000 because the FSD will get better and better and better. The economics will get insane, so people will buy it. And revenue and net income projections, net margin increases from 30% to 70%. And yeah, so let's see what it comes up with. Units sold in year 1 is 2.4 million. Car probably a bit too bullish. Okay, cars on the road, it's like 4 million cars on the road. It was like also my number I had in the back of my mind. FSD take rate 10, like was it 10%? But take rate increases every single year linearly. And yeah, the cost of FSD has already increased after 1 year to $2,280. FSD revenue is then 1.6 billion because it just uses this cost and multiplies it with the take rate and the number of cars on the road. And it determines the net margin by using this number. And no, the net margin is starting from 30%, but then going like increasing it by 4% every single year. And because it becomes more and more a software business, without the expense for FSD can now be divided by into more units. So each unit basically needs to take a smaller and smaller loss on FSD research and development. And net income is then this 1.65, so the revenue number times net margin, 0.5 billion USD in year 1. And in year 10 we have an FSD revenue. Okay, so it just gives me the formula, it doesn't give me the answer. Here it calculates these things. I hope it did it right. Units sold sounds reasonable to me in million. So we have 36 million. Then we have cars on the road, 107 million. Teslas on the road. It's like 3 times what they sell in the year, right? It's reasonable, I think. We have billions of cars on the road, so this would assume Tesla is like one of the major players, not the only player, for sure. FSD take rate would be 90% in this scenario, assuming we don't. This take rate would be insane if we would also have a Robotaxi network fee or platform fee, but we don't, right? And you could like adjust this down and increase the platform revenue if you add platform revenue to your model. I don't. And FSD cost would be 12K in this scenario to keep the economics in favor of the consumer. And net margin of 70%. Net income would be 800 billion. So this is an insane number, right? But I mean, other players have also, other experts in the space have also come up with similar numbers. So it's not my own. I'm not the only one assuming significant contribution of the Robotaxi network to the stock price. So the present value would be 261 billion only from the profits in year 10, right? So this is insane. So this shows the present value of the net income from Robotaxi network over the next 10 years is approximately 636 billion. But this is only the next 10 years. So now we have, what about the terminal value? So because we will also have cash flows after year 10, right? And we don't assume like any significant growth after year 10. We only assume a perpetual growth rate of 3% or so, and we use a discount rate of 12%. But I think we should increase the discount rate because the numbers of assumptions here is significantly higher now, and the risk factors is also significantly higher. So we will completely redo this analysis. So here in this scenario, it has assumed like a 967 billion terminal value. So you see the terminal value is higher than the value for the next 10 years of cash flow, which makes sense, right? So cash flows from year 11 to infinity is more valuable than cash flow from year 1 to 10, especially if for this high growth segment. here I will adjust this query. We will just remove everything it gave us as an output, and ask it, what about the terminal value? Assume a 15%. It's just much more defensive now. Assume a 15% discount rate. So we discount all future cash flows 15% every single year. So which means that future cash flows will become very worthless very quickly, which is a much more defensive way of looking at it. So I'm curious now. So currently it estimates the present value of the future cash flows from the Robotaxi network would be 1.6 trillion. Okay, now let's after this exercise, after increasing the discount rate to 15%, discount the present value of the Robotaxi network to, it goes over. Okay, so let's step by step. First, it calculates the terminal value at year 10. So this is basically the value of year 10, and then you have the present value of the terminal value by discounting it with the 15% growth rate. So we go from 71 billion. This is the cash flow we could obtain from selling the business in year 10, but this would be worth much less. Is it only 8 billion in this year 10? It's 800. So there's something wrong here, isn't it? It's not 8.3 billion, it's like 8. No, this is completely broken. I think, there's a mistake. What about the terminal value? Assume a 15% discount rate and redo the whole analysis for, you know what, I will go one step back here. I think it might be already confused because of the long history. Let's go to the Robotaxi network, increase your net. No, I would like to keep this. I would like to keep this. Okay, what about the terminal value? Assume a 15% discount rate and do the whole analysis. Based on this 15% discount rate. Let's see what it comes up with. Okay, the steps it wants to do is recalculate the yearly projections with a 15% discount rate, calculate the terminal value using perpetuity growth model, sum up present values to get to the total present values. So first what it does, it uses the initial units sold of 1.8 million, it uses a growth rate of 35%, churn rate of 10%, initial FSD take rate 10%, final FSD take rate 90%, initial FSD cost, initial net margin 30%, final net margin 70%, discount rate 15% over 10 years. Then it goes over all the years and comes up with what? With this table. Okay, this table here gives us let's just go to the bottom. Here we have a 70% net margin. We still have the same 811 billion net income, and the present value of this is now only 200 billion. So the 800 billion income in year 10 from FSD sales would be only worth 200 billion in today's cash flows. And if we adjust this, we get the total present value of net income in 10 years, 500 billion, so which is just summing over all these numbers. It's the 500 billion, and the present value of the terminal value is 1,700. The total present value is 2.2 trillion. Now I want to know how it comes to the terminal value. The terminal value, it uses net income, the last net income. It is 1 plus the 3% growth rate. Okay, so it assumes a 3% perpetual growth rate. and divides by our discount rate minus the growth rate. So it seems reasonable, seems okay to me. Present value of terminal value after years, and the variable years is what? $10. So what is the formula for the terminal value? Terminal value formula. It's the free cash flow. So okay, so it's the free cash flow in the year times 1 plus the growth rate divided by the weighted average cost of capital minus G, the growth rate, the final growth rate. I'm not quite sure if it calculated this. Did you use the usual formula for the terminal value in a DCF analysis? It's still here it assumes this. I am struggling because here it assumes an 8.38 billion USD, right, for the free cash flow in the year 10, but we actually have an 811 billion. So I don't know where this comes from in net income. So this seems wrong. It did a mistake here in a way. I think you used the wrong net income number in year 10. It's in the hundreds of billions of USD. Check your previous numbers again. Okay. Okay, use the initial units, so now it goes over the whole exercise once again, right? But now at least the terminal value, actually the formula looks better, right? Here we have this terminal growth rate G of 0.03, and we have the terminal growth rate here as well. This looks more like the formula we have just seen. And then the present value of this future cash flow is then discounted back to the, okay, so this looks reasonable to me now. Okay, we are already almost an hour in, and we have not even reached the humanoid robots segment. But I think this will be a bit wilder, and but it will be quicker as well. Okay, net income in year 10, it's 800 billion. Okay, terminal value year 10 is, yeah, this makes sense, right? This 6.9 trillion for our assumptions, and then we present back to the we calculate the present value of these future cash flows. Okay, the total present value is 2.2 trillion, including the terminal value. So we have a 2.2 trillion dollar value of the Robotaxi segment already. Like, this is what you could pay today if you would be happy with a 15% annual growth of your investment, and this would actually play out on average in an average world kind of it would play out like this. It could be significantly higher, it could be significantly lower, but this would be the kind of the average an average scenario in my opinion. I don't think it could be say 10 times higher like that or so. I mean, anything could happen, but I don't think it would be reasonable to assume that our numbers would be 10 times that, right? So we would have say 10 times more robotaxis on the roads, or maybe 10 times more revenue per robotaxi or so. I think it's a reasonable assumption. Reasonable assumptions here we did, and the present value is not too extreme in a way. Like paying 2.2 trillion would mean that you would pay less for the robotaxi network today than you would pay for Apple today. And Apple is one of the most valuable companies. They are proven. The robotaxi network is not proven, but that's why we use the high discount rate. Also, Apple wouldn't have a 15% discount rate to their cash flow. So in a way, we adjust our uncertainty by using a higher discount rate. Okay, good. So now let's analyze the humanoid segment next. Let's analyze the humanoid segment. It's simple. Assume 1,000 robots in 2024. Let's be extra conservative. Make it 2025. Okay, 2000. We start with the year 2000. Let's make it realistic. I think it's 1,000 in 2024. Then grow the number of robots such that in 10 years we reach a production of this would be 10,000 robots every single year, but I think we will see much more. A production of 100 million robots in 2034. It's 10 years later, right? So we go from 1,000 to 100 million robots in 2034. And we sell each robot for 20K. We make profit of 8K per bot. Very simple model. I mean, if those bots, even today, the capabilities of those bots would mean that they could do work or labor of a human that is paid like 50K or so a year, right? Just for standing, say, on a machine, I don't know, transporting some pieces from A to B, maybe checking the output of a production facility or so for errors, and then just taking those and throwing the erroneous products into the garbage or stuff like this, right? Or maybe security that just walks around the building and alerts, I don't know, some security system or so if it finds an intruder. So these kind of works could be done today with the capabilities of the bots today, and you would pay like 50K at least per year for an employee doing this, and it is necessary work. And now we could already hire a humanoid robot, and if you would pay only 20K, you would actually pay 40% once, 40% of the cost of an employee every single year. So we would, so if you are a business owner, you could decide to pay 20K once or 40K every year, plus the expenses for, say, taxes and social security, and also the uncertainty you have and the journey you have. If you hire human talents, you also have like you need to pay for human resources department and stuff like this. It's like a no-brainer. And and this is with today's capabilities, but then of course in 10 years we will see significant growth of these capabilities. So it's only a matter of production. How fast can we churn those things out? And there's a lot of analysis online that you can find that suggests that at volume, say if you produce 1 million or so of those bots every single year, we could bring down the cost to 8K or so per unit. And we could easily sell those for 20K, as we have just seen. Probably we can sell them much more expensively, right? But we assume, like just as Elon said, we sell it at 20K. And the capabilities of those robots are exploding. These are very like sandbagged assumptions in my opinion. So we make only profit of only 8K per bot. Let's see what it comes up with. Maybe I'll stop it here and I'll use the discount rate. I think this is much more certainty than the Robotaxi network in my opinion, because I just cannot see any issue happening here, right? It's like Tesla's already the leader. They have proven the production capabilities. The demand is infinite. The regulatory uncertainty is much less. The danger from a humanoid robot is much less than, say, a car driving at 200 miles per hour or 100 miles per hour over the streets, right? It's much more dangerous. It's a question of life or death. So there's much more uncertainty in Robotaxi network than there is in the bot network, in my opinion. We make profit of 8K per bot, so we assume a 10% discount rate as well. It's the killer product. It's the ultimate killer product. We all want a humanoid robot, maybe even multiple, and we all would take one, right? And if it could cost 20K, we could get one for $100 each a month or so with some financing, and like a cheap car. So we pay $100 a month, and we get like a human-like worker that does everything for us. Work worth thousands each month, right? So we pay 100. We let it like do some simple jobs, and it would create thousands of value for us. So it would be a no-brainer, right? And we start with 1,000 robots and grow to 100 million robots in 34. And this is only the beginning. Then 10 years later, we will have billions of robots. We will sell billions of robots in each year. So this would actually be the scenario. This would be similar to the smartphone market. So this assumes that the humanoid robot segment is as successful as the smartphone market, not more or less successful, like similar in success. It probably will be more successful, but okay. Each robot is sold for 20K and the profit per robot is 8K. We use a 10% discount rate. So the yearly projections for robots sold, they first get a compounding annual growth rate of like a huge number, right? And now it calculates, it gives me this table. So we have robots sold going from 3,000 here in the next year, after 1 year, to 10,000, to 31,000, to 100,000 after 4 or 5 years. Doesn't sound too unreasonable to me. Then after like 7 years, we have 3 million robots. So we sell, say, as much robots as cars today in 7-8 years. And we finally reach 100 million robots, units sold in year 10. And so we have a profit, huge profit of 5, what is it? Is this even possible? If we sell robots sold 1 million, but we don't have 1 million units sold right after 10 years. So this was wrong here. It should be 100 million, not 1 million. Okay, so there's an error. There is an error. I think in year 10 we want to sell. So you always need to be careful with ChatGPT-4o. with all language models. That's why human plus AI is a much more powerful combination than just AI. So you need somebody to fact check and check the output. There's an error, I think in year 10 we want to sell 100 million units, not 1 billion units. Okay, now it recalculates the growth rate to ensure we reach 100 million units by year 10. I also like this. I initially worried that it would have a linear projection or so. So it would go from linearly from say a couple of thousand bots to 100 million, which would mean that it overestimated the number of units sold in the earlier years, which could lead to a higher valuation than in reality, because in reality we would take some time to ramp production up, so it would be more an exponential growth curve than a linear growth curve. But it figured this out, so this is great. So now we go from robots sold from 3,000 to 100 million, which seems correct. So let's have a look at those numbers. Here we now the robots sold in year 10 is 100 million, but these numbers look completely wrong again the other years. So I don't know what it does here. I mean, here we have the revenue is in billion. This doesn't make any sense. Now here it assumes 300 million. Okay. Still wrong. Go over all your 10 years of robots sold. We go from thousands to 100 million in 2030. So the growth rate, if you have a 900% growth rate, then it says we can do it. Okay, let's see. Maybe this is more reasonable. We can basically check. So what happens if we start with 1,000 robots? I think it was more like in the first year, and we multiply with 9 to the exponent of 10. So roughly, right? Maybe I could be off a bit, but okay. So we 9x for 10 times. Now we get to this number. This number is 3.4 times 10 to the power of 12. So if you have 10 to the power of 12, so we have 3. So this would be 400. This would be 3, 6, 9, 12. Okay, we might be off a bit. Okay, let's see what ChatGPT does. Here again, it has like this billion. Okay, this is really a mess. Okay, just assume robots sold going from 1,000 to 10,000 to, I don't know, 100,000 to 1 million to 10 million to 100 million, with some random numbers in between. Because it would be also not changing too much, right? It depends mostly on the final number of robots. Okay, so we have 1,000, 10,000, 100,000, 1 million, 10 million, 50 million, 100 million, 150 million, and in the 200 million, 250 million, 300 million in 2034. Why 300 million? This is a bit frustrating. Now it doesn't seem to get it. Let's execute this calculation to ensure the correct projections. You know what is, I will take those numbers, stop this calculation because it's based on the wrong, just assume robot sold like so, and we will use those numbers but adjust them a bit. So here we have, say, 20 million, here we have 30 million, then we have 40 million, then we have like 50 million, then we have 60 million or so, and then finally we have 100 million. Units sold like so. Okay. Based on these numbers, calculate the DCF. Also adding the terminal value. Okay, let's see. Let's send this. Okay, we are almost done. Just this final segment we need. Selling price per robot 20k, profit per robot 8k, discount rate 10%, looks good. The number of units sold is correct here. Step-by-step calculations. Did it use the right numbers? Seems so. Here in the last column we have 100 million. Okay, this looks good. Okay, our revenue goes from 0.02 billion to 2 trillion. Now this looks reasonable to me, right? We have 100 million units sold. We sell it for 20,000 per unit. So we have 100 million times 20,000 is 2,000 billion. Looks correct to me. Profit of 800 billion, and then of course we need to discount it back to the present, so we have 280 billion. Profit in year 10 contributed to today's value. Good, looks good to me, everything correct until now, and the terminal value calculation is 4 trillion, and yeah, the total present value would be the sum of the terminal value and the summed value over the first 10 years. So the value in the first 10 years is like marginal. You see, I mean, it's significant, yes, but after 10 years, we still have not accumulated as much cash flows as the company's worth today. But then after that, it will be huge because of even if we assume like a small growth rate, a terminal growth rate of only 3% or so, because then the cash flow, they really like the huge cash flow, they only come after 5-6 years or so, right? Here we have like huge cash flows, like Apple-like cash flows we have in 29 or so, right? We surpass Apple today in terms of cash flows from humanoid robots under these assumptions. Okay, so this gives us total present value of 5 trillion. Okay, now do the sum of the parts analysis. Give me the total value, market cap of Tesla today. Visualize it as a pie chart as well to see where the value comes from. So now I'm curious. Like Tesla today's market cap once again is 0.7 billion. It grew by 3% today. 0.7 trillion, and here it says the total value of Tesla today is already like the value of the car business is 1.8 trillion, discounted to the present. The value of the energy segment is 48 billion. This is probably very underestimated because I don't trust the number too much. Because I don't trust my own understanding of this too much, I use the most conservative assumptions. The Robotaxi network is roughly as valuable as the car business under these assumptions, and the humanoid robots segment would be 5 trillion in value. So together, car plus energy plus robotaxi would not be as valuable as the humanoid robots segment. If you would trust only one of those valuations, if you would add a value, say, of 0 to energy, robotaxi, and humanoid, if you don't buy these kind of arguments, and you don't assign any value to it, but you would buy the car business story, you could still purchase the future cash flows very cheaply, right? Because you would pay 0.7 trillion in order to get a 1.8 trillion dollar company. So there's still margin of safety, significant margin of safety. No financial advice. This is like only based on this assumption and the valuation we did here. It's a combination of my own biases and assumptions and ChatGPT's like technical support, so to say, and it could be completely off. It is not ChatGPT's assumption of the future valuation. If you would ask ChatGPT without providing human context and injecting human bias, you would get a much more bearish view on Tesla. But this is my like combination, like my interactive valuation using the ChatGPT-4o as a tool for valuation. And this visualization is very beautiful, actually, I think. So the humanoid robot segment would contribute 55% of the value of this total valuation. The car business would contribute 1.8 trillion. The Robotaxi network would contribute 2.2 trillion, and energy would be marginal. Okay, now one final step. So if I invested $10,000 today in TSLA, what would my investment be? Worth today using these valuations. So this is like value and price, right? What would my investment be worth in 2023 at 34? And it would be significantly higher even, right? So this is like, if you sum those values, you would add like 1.8 trillion plus make it 1.9 with the energy plus 2.2 trillion. So we are already at 4.1 trillion, and we add 5.1. So we have 9.2 trillion market cap. This would be the value today. And we still have the discount rates, right? Remember, so we have $9 trillion business for 0.7 trillion cost. So the price would be 0.7 trillion, but the value you get for paying this price would be 9 trillion if you would buy all those stories. And then of course you need to assign a probability to the different stories, maybe, if you want to be even more conservative. Usually you don't assign probabilities to discounted cash flow analysis because you have the discount rate, right, to adjust the uncertainty of your assumptions. So the projected market cap would be significant. The car business would be 1.8 billion. It assumes growth to a higher valuation. Okay, for simplicity, number of shares purchased. Future market cap would be 18 trillion. Could be possible, right? Why not? So why does it assume 3.225 shares? So let's go maybe over it. Current value of investment $10,000, worth 3.225 shares at $3,100. per share. So this was kind of broken. Maybe I had a wrong. I used the wrong query here. If I invest $10,000 today in Tesla, and the 4 growth stories would play out exactly like this, what would be my investment worth in 2033? Use number of research, number of shares online. Garbage in, garbage out, right? if I have a like imprecise prompt, then I will get imprecise results. Let's see if I get better results with this prompt. The current market cap of Tesla is 9.3 trillion, but this is not the current market cap. This is the current value. It doesn't get this different, right? The current market cap of Tesla is, I will add this to I will just skip this whole computation and once again change the prompt in Tesla and a market cap of 0.77 trillion. Okay, now it browses the number of shares outstanding. It has 3.19 billion shares outstanding. Is this true? Tesla shares out. Yeah, it might be. Yes, 3.18 billion shares outstanding. Okay. Current market cap is 770 billion, so the current price is roughly $240 per share. Roughly right. If you invest 10,000, we would get 41 shares. The future market cap is 9,300 billion. So the future share price at any point would be 2,900 per share. So we would have a 120K Nasdaq. Okay, so our $10,000 investment would be worth 120,000 in 2033 under those assumptions. There's one thing we probably need to adjust, and this is that it would probably be higher because we used the discount rate, and now it just assumed we grow into the fair value, which was 9 trillion. But it doesn't only grow into the fair value, it also grows because of our discounted rate, right? But I mean, this is like a nuance. It would probably significantly change our investment, could be maybe 5 times that high or so. But let's assume it just grows into the fair value to be even more conservative. Okay, so your investment could go from 10,000 to 120,000 in 10 years under this analysis. No investment advice at all. This is just putting stuff into ChatGPT-4o, brain dumping things into ChatGPT-4o and looking at the results. This is pretty similar to my assumptions. I think it could be even more bullish if we look at the humanoid robot segment, but okay. And I could be off by a couple of years, but I think it won't change too much because eventually if they sell 100 million bots, the valuation would be that high, right? And it wouldn't change too much if we add 2-3 years to this investment time horizon. I think the risk is very low because even if, say, the crazy bets like humanoid robots and FSD or so don't play out, we won't lose a lot of money because of the car business is also very attractive. Thanks for being a loyal watcher of these kind of videos. I appreciate having you here. If you watch the whole 1.5 hours, You are really, I'm proud of you. You are really one of the hard Finxter fans, and yeah, I appreciate you especially. Thanks for being here and talk to you. I won't have to ask you to subscribe because you are already subscribed to the channel if you have watched this long. Let's be on the right side of change and talk in the next video. Bye.